Most people missed what happened this week in the gold and silver markets. Not the price move itself. That made a few headlines. What almost nobody noticed was how the largest institutions adjusted in the background when those prices moved. You did not see a front-page crisis. You did not see emergency press conferences. But in the data, in positioning, in the way rules and margins were tweaked, you can see something else forming. This is not panic. It is a pattern. The reason this moment matters is simple. For the last decade and a half, markets have been built on one assumption. If something breaks, the central bank cuts rates, adds liquidity, and buys time. That model worked when inflation was low, debt was cheaper, and confidence was higher. Now we have the opposite. Higher interest rates, record public debt issuance, and a banking system still digesting losses from the last rate shock. Against that backdrop, gold quietly breaks to new highs, silver refuses to trade like a forgotten commodity, and institutional behavior in the metals market starts to diverge from the old playbook. That combination is different from past noise. If you care about inflation, about the stability of your bank, about what happens to markets when confidence is stretched, metals are worth watching, not because they are magic, but because they are early. They tend to move before the headlines catch up. When gold makes a new high with very little retail excitement, when silver's paper price says one thing while physical premiums say another, it usually means pressure is building somewhere in the plumbing of the system. And when pressure builds, rules have a way of changing quietly. To understand why metals are behaving the way they are, you have to start with the macro environment. Interest rates are no longer near zero. Policy rates in the U.S. are at levels that a few years ago would have been considered restrictive. Long-term Treasury yields have repriced higher, which means the cost of rolling over the federal government's debt has increased materially. At the same time, deficits are structurally large. The Treasury must sell an enormous amount of new bonds into a market that is more selective about what it will absorb and at what yield. On the liquidity side, the world is less cushioned than it was. Central banks are no longer expanding their balance sheets the way they did after 2008 or 2020. In the U.S., quantitative tightening is slowly withdrawing reserves. The big pool of excess cash that once sat in the reverse repo facility has been drained down. When liquidity is abundant, stress can hide. When liquidity is tighter, problems in one corner of the system transmit more easily to others. Commercial banks are carrying scars from the last rate shock. When yields jumped, the market value of their bond holdings fell. Most of those losses were labeled unrealized for accounting purposes. But the economic reality is straightforward. If deposits leave, someone has to fund those underwater assets or sell them. That is exactly what took down several regional banks. The response? New emergency funding facilities, tweaks to how collateral is valued, solved the immediate run, but it did not eliminate the underlying interest rate risk. It simply changed who was sitting on it. Into that landscape, look at institutional positioning. Large U.S. banks report hundreds of billions of dollars in precious metals derivatives exposure on a notional basis. That notional value does not tell you whether they are net long or net short, but it does tell you one thing. Metals are deeply integrated into the risk management and trading structures of the banking system. Metals are not sitting on the fringe. They are part of the machinery. At the same time, central banks, particularly outside the United States and Western Europe, have been net buyers of physical gold at a pace that is historically unusual. Official sector gold buying has reached or approached record levels in recent years, even as the major financial centers publicly discuss diversifying reserves and reducing reliance on any single currency. When policymakers who sit at the core of the current system quietly accumulate an asset that exists outside that system, it is a signal. They are not speculating on a quick price spike. They are adjusting to a world where trust in paper claims is a little thinner. That combination, higher rates, heavier debt loads, more fragile bank balance sheets, and official buyers quietly increasing their gold holdings, is the backdrop against which this week's moves in gold and silver sit. It is the context that tells you this is not just another commodity chart. Where is the pressure actually forming? You can see it in three places: collateral, confidence, and the growing gap between paper promises and physical reality. First, collateral. In a high-debt, high-rate world, high-quality collateral is everything. Government bonds traditionally play that role, but when their prices are volatile, the amount of leverage you can safely build on top of them shrinks. Margin calls become more frequent. Haircuts rise. That is one reason gold has been quietly re-emerging as a form of neutral collateral in some bilateral arrangements and in the behavior of central banks. It is nobody's liability. It does not depend on any one government's fiscal policy. For institutions that think in terms of decades instead of quarters, adding a layer of neutral collateral makes sense when the traditional collateral base looks unstable. Second, confidence. Banking is confidence. Markets are confidence. You do not need a formal default to shake that confidence. You just need enough doubt about how losses will be shared, how deposits will be treated, or how rules will be applied under stress. We have already seen one example. When regional banks came under pressure, new emergency measures appeared overnight. Insured deposit limits were treated flexibly. Shareholders and some bondholders took hits, others were shielded. The message to anyone watching closely was clear. When the system is under strain, The rulebook can be edited in real time. Third, the gap between paper and physical. In gold and silver, this shows up in a very specific way. The financial system trades enormous volumes of paper claims on metals, futures, forwards, swaps, unallocated accounts that are not one-for-one backed by physical bars sitting in a vault. In normal times, that is not a problem. The fraction of holders who ever ask for delivery is tiny. The system relies on the idea that most participants are happy to settle in cash. But when confidence is shaken, that assumption gets tested. More people and more institutions shift from "I am comfortable with a promise" to "I want to know the metal is actually there." That shift does not have to be large to matter. If even a small percentage of paper holders demand physical delivery at the same time that new buyers want bars, the system can feel it. You see it in rising premiums on coins and small bars relative to the futures price. You see it in inventory data from major exchanges and vaults. You see it in the trade flows between Western financial hubs and Eastern physical markets. This is where gold and silver start functioning as stress indicators rather than investments. Metals do not generate cash flow. They do not pay dividends, they sit still. But the way different parts of the market price those claims, and the way institutions behave around them, tells you a lot about perceived risk. Think about the difference between paper and physical metals. On one side, you have futures contracts, unallocated accounts, and exchange-traded products. These are essentially promises, claims on metal that may never be exercised as delivery requests. On the other side, you have physical bars and coins, vaulted or held outright. These are not promises. They are the thing itself. In calm environments, the price difference between the promise and the thing is very small. Arbitrage keeps it that way. If futures get too cheap relative to physical, someone buys futures and stands for delivery. If futures get too expensive, someone sells them and buys physical, locking in the spread. As long as you trust that delivery will occur and counterparties will honor contracts, the arbitrage is straightforward. When trust weakens, that bridge between paper and physical becomes less certain. Two things can happen. The first is simple. Physical premiums rise. Retail buyers see this every time there's a scare. The spot price prints one number, dealers quote another. Some of that is basic supply and demand. Mints have limited capacity. Distribution channels get clogged. Inventories thin out. Some of it is risk. Wholesalers and dealers are not sure how long it will take to restock or at what price, so they build in a buffer. The second is more structural. In wholesale markets, you can get temporary divergences between different trading centers. When gold trades consistently at a higher price in one region versus another, or when one exchange repeatedly sees contracts roll instead of deliver, it suggests that the metal is flowing in one direction and not coming back. Over time, that can hollow out the available pool of physical collateral in certain locations. This is one reason suppression narratives exist in the metals world. Observers see large volumes of paper selling appear at key moments. For example, when gold approaches a prior high, and they interpret that as an attempt to cap the price. In some cases, it may simply be algorithmic trading, hedging activity by miners and refiners, or portfolio rebalancing by funds. In other words, there are structural reasons for heavy selling that have nothing to do with an organized campaign. But from the perspective of a market participant, the distinction is less important than the pattern. If prices repeatedly bounce off the same ceiling on heavy futures volume, while physical demand remains firm, the message is that there is a large, price-sensitive seller in the paper market. Whether you label that suppression or just institutional hedging, it tells you that someone with size is defending a level. The reason that pattern matters is that large players are usually comfortable taking the other side of public emotion, but they are not comfortable fighting structural shifts. When you start to see those ceilings break decisively, especially without a surge in retail excitement, it often means that the people who were leaning against the move have stepped back. Either their risk managers told them to reduce exposure, or their hedging needs changed, or regulators adjusted capital treatment. The motives vary. The outcome is the same, less resistance. We can see some of this in recent gold behavior. The metal has pushed to record or near record levels in nominal terms, even while real interest rates, yields after inflation, are not deeply negative. In previous cycles, you typically needed strongly negative real rates to justify those kinds of gold prices. Today, you have gold trading as if it were already in a stress environment, even though the surface still shows relative calm. That divergence between traditional models and actual prices is a signal that the market is pricing in something structural, concern about fiscal sustainability, about future inflation, or about the reliability of paper claims. Silver tells a slightly different story, but it rhymes. On the surface, silver often looks like it is underperforming. It has not kept pace with gold's new highs the way it did during past episodes like 2011. That leads some observers to dismiss it. But look underneath at positioning and at the physical market. Futures data have periodically shown commercial users and producers reducing their net short exposure, while speculative funds swing short at precisely the moments when industrial demand remains firm and mined supply growth is flat. Warehouse inventories on major exchanges are lower than they were several years ago. Meanwhile, Premiums on certain forms of physical silver remain elevated relative to what you would expect if the market were genuinely oversupplied. Those cross-currents suggest that the paper market is being used as a pressure valve. When institutions are nervous about broader macro conditions, but cannot or will not express that view directly in the bond or equity markets, they sometimes express it in relative trades, long one asset, short another, or hedged exposure through metals. Silver, with its smaller market size and dual industrial monetary nature, becomes a useful instrument. The net effect is that its price can look wrong if you only think in terms of simple supply and demand, but very logical if you think in terms of balance sheet hedging and institutional behavior. History gives us parallels, and they are instructive if used carefully. In the late 1960s, the London Gold Pool, a coordinated effort by major Western central banks to keep the gold price fixed in dollar terms, eventually broke when physical demand overpowered official selling. The breakdown was not just a story about speculators, it was a story about confidence in the monetary system itself. When that confidence eroded, the promise of convertibility could not be maintained at the old price. The rules had to change, and they did. In 1980, the Hunt brothers' attempt to corner the silver market created a very different kind of stress. There, a concentrated group of buyers drove prices to extremes. The response was not a simple free market correction. Exchanges changed margin requirements and position limits in ways that disproportionately impacted those long positions. Again, when stress builds, rules change. The mechanics may differ, but the pattern is similar. Pressure reveals who has the power to rewrite the game in real time. More recently, in 2008 and again in 2020, we saw episodes where metals behaved as both safe havens and sources of liquidity. In the early stages of crisis, gold often sold off along with everything else as investors raised cash to meet margin calls. Then, as policy responses took shape and confidence in fiat instruments was questioned, gold surged while real yields fell. The key lesson is that metals can be hit in the first wave of liquidation, but then lead the recovery as the system absorbs the shock and reprices risk. Today's environment shares elements of all these episodes, but is not identical to any of them. We have fiscal metrics that look more like a late-stage cycle, a global shift in reserve composition, a banking system with thin capital buffers relative to its true mark-to-market risks, and a metals market where the centers of physical demand are shifting east while the centers of paper trading remain in the west. That geographic divergence introduces a new dimension. Pricing power may slowly migrate with the metal. So what could come next? Not as a prediction, but as a set of conditional scenarios. In an orderly adjustment scenario, the current pressures continue, but institutions absorb them gradually. Central banks keep adding gold at a measured pace. Commercial banks slowly reshape their balance sheets, recognizing more of their interest rate losses over time instead of all at once. Gold grinds higher, or at least holds at elevated levels, reflecting the new reality of higher debt and simmering inflation risk. Silver periodically spikes when industrial users scramble for supply, but is pulled back by macro-driven selling from funds. In this world, metals function as a kind of barometer, but not as the epicenter of crisis. The rules do not have to change abruptly, they just bend. In a rolling stress scenario, we have intermittent episodes of acute pressure in specific parts of the financial system, a cluster of bank failures here, a sovereign funding scare there, perhaps a disorderly move in a major currency pair. Policymakers respond each time, but the solutions are narrower and more political. Liquidity is provided, but at a cost. New regulatory tweaks appear after each event. Over time, more participants decide they would rather hold a portion of their wealth and reserves in assets that sit outside those shifting rule sets. Central bank gold buying accelerates. Private demand for physical metals becomes more persistent, especially in regions where trust in domestic institutions is already fragile. In this scenario, you might see more frequent gaps between paper and physical prices, more rule changes on exchanges when volatility spikes, and a slow migration of pricing influence toward venues with stronger physical backing. In an acute break scenario, one of the existing fault lines gives way, a major bank reveals larger than expected losses, a key government struggles to roll over its debt at sustainable rates, or a geopolitical shock leads to sanctions that freeze a significant bloc's reserves. In that environment, metals are not just indicators, they become escape valves. Demand for physical explodes relative to the ability of the system to deliver it. Paper markets struggle to keep up. Position limits, margin rules, and settlement terms change rapidly to preserve the functioning of exchanges and dealers. Spreads between paper and physical can widen sharply until a new balance is found. In such periods, the precise price level matters less than the message. The old assumptions about liquidity, convertibility, and safety are being rewritten. It is impossible to say in advance which of these paths we will follow. Reality often contains pieces of all three. But watching how metals trade relative to real rates, relative to news, relative to other risk assets, and relative to their own physical markets gives you early clues about where we are on that spectrum. What does that mean for an individual observer? Not a recommendation, but a framework. If you choose to watch or hold metals, the headline price is only one data point. The structure of the market often tells you more. Are futures curves in contango or backwardation? Are physical premiums rising or falling? Are exchange inventories being drawn down steadily, or are they replenishing? Are central banks steady buyers or occasional sellers? Is speculative money fighting the trend or going with it? They do not require insider information. They require patience and context. They reflect the present more honestly than many other assets because they are less tied to growth narratives and more tied to trust. As pressure builds in a complex system, the first signs are almost always in the relationships between markets, rather than in the level of any single index. When gold rises, while risk assets are still complacent, when silver's physical market tightens even as its futures price chops sideways, when the gap between Eastern and Western prices persists, those are not random quirks. They are expressions of a deeper reality. Institutions are adjusting beneath the surface. The key is to stay calm and analytical in the face of that adjustment. Markets will overshoot. Narratives will swing from complacency to alarm and back again. In those swings, you will hear confident declarations that metals are obsolete one month and that they are the only safe asset the next. Neither extreme is helpful. Metals are tools. They are signals. They are not saviors. When you see the world's biggest institutions slowly accumulate physical gold, when you see rule changes at exchanges during bouts of volatility, when you see premiums and spreads behave in ways they did only during past stress episodes, it makes sense to pay attention. The story developing in gold and silver right now is not about a single bank or a single trade. It is about a monetary order that is being tested at the edges. It is about how much debt can be piled on a base of confidence before that base starts to shift. And it is about how institutions that helped build the current system are quietly hedging the possibility that it will not look the same a decade from now. Metals have seen these transitions before. They carry no opinion, no ideology. They simply respond when enough people and enough institutions decide that owning a claim on someone else is not quite the same as owning something outright. That is the signal to watch. Not the noise of daily price ticks, but the slow, deliberate changes in behavior that tell you stress is building long before it breaks the surface.